Hey Bowtie Nation, Joseph Hogue here, and the best part about our Monday Market Open live streams is being able to answer your questions and connect with all you out there in the community. The worst thing is an hour and a half into the stream and I'm starting to feel like a minute steak on its third hour in the oven. I'm done. The fact is I can't always get to all your questions, so I put out a request in the community tab for your biggest questions about stock investing right now. We got 73 responses, but of course half of those were spam, because that's the world we live in now. But in this video, I'll answer 10 of your most important stock investing questions. I'll leave a clickable index of the questions in the description below if you want to skip around, and I'm going to answer another 10 questions in our next video. So make sure you join the community, tap that subscribe button so you get notified when that comes out. Our first question is from the Dividend Daddy. He says, hey, I've been wanting to set up a portfolio for my kids for me to manage and then give it to them when they're older. I was wondering, what stocks would you set up with that long-term portfolio in this scenario? And I love this question, and I'm probably going to turn it into a longer video later because it's so important to start your kids investing, even if it's just a little more hands-off here like this with where you're setting something up and then managing yourself. Here, I'd like to focus on two ideas though. The one, that time horizon on investments and what that means for the stocks you pick. You know, with 50 or 60 years to retirement, your kids have an immense opportunity to see that money grow and don't have to worry about that year-to-year boom and bust cycle in the market. If you look at where the stock market was 60 years ago, and here's the S&P 500 and the Dow from 1962, it would have been around an 8,000% return on your money just investing in the index itself. That's 80 times whatever you put in there. Another great opportunity here is to get your kids interested in saving and investing by picking a few of the stocks from their world. You know, put some Disney in there, some Hasbro and Mattel, maybe some Roblox, and explain to them what this means, that they actually own a part of that company. And then get them interested in that process of saving and then investing. Help them make the connection between working to make money, not spending all of it immediately, so they can save and buy a little more ownership in the companies and how that investment grows over time. Next question here is from Andrew H. I think a great topic would be around how to invest during times of recession, which we're expecting. What asset classes, strategies do you use to make money in seemingly impossible environment to make money? This is the big question right now, right? I'm going to link to a couple of blog posts from My Stock Market Basics in the description for more detail, but I'll give you the cliff notes here. Now for assets, stocks are going to be rocky over the next year, as I do think we see a recession in 2023 as just those higher interest rates from the Fed and inflation start to affect the economy. And bonds are that traditional safety investment, but haven't really helped so far this year because of those higher rates. Now that said, I think the best thing you can do here is kind of a counterintuitive strategy. Investors love to push all their money into stocks as prices are surging, but then get scared and avoid stocks in a bear market. And why? It makes no sense. When the market eventually does recover, those prices that you're getting in a crash right now, those are some of your best investments. So my biggest recommendation here is just invest more in stocks as the market falls. And when the market hits those new highs, that's when you want to start shifting into bonds and other safe investments ahead of the next crash. Now that said, I don't think we've seen the low in the bear market just yet. So you can do this strategically without pushing all your cash into stocks right now. Now, I've recommended on the channel before picking index levels on the S&P 500. So if the market gets to certain points like 3650, then 3500, then 3250, you use part of your cash to buy more stocks and take advantage of those lower prices. We're just getting started on your stock investing questions, but I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the nation, so look for that sign up link below. Next question is from Shaping. Joseph, hope you're doing well. Thanks for that. My question is, do you think we've hit the bottom or could go lower from here? I see some analysts think we're going to go 25% more on the S&P, which would be devastating, and I agree it would. I personally don't think that the economy seems fine, but I'd love to hear your thoughts. Now this one is kind of related to the last one, right? And I do think we see the market head lower. And we were oversold into that May and due for a summer rally, but it's just hard to see how the Fed is able to get that inflation under control without raising rates so much it's going to choke off the economy. We've never been at the point before where the Fed needed to back out so much stimulus, so much money out of the economy, where inflation was so high at the same time. And you do see a lot of conflicting targets, though, in the market, right? JP Morgan is sticking with their 4,400 target for the S&P 500, which should be about 7% higher from here. While Morgan Stanley is still calling for 3,400, which be about 17% lower. I think there's a very good chance we get it at least 3,500, which would still be about 27% from last year's peak, 27% down. And if you look at bear markets in the past, the average is 28% from the peak, so 28% below the most recent peak. And those that were followed by a recession, which is what we're probably looking at this time, those have averaged even more like 35% down from the peak, which would mean about 3,100 on the S&P 500. And another 24% lower from here. Next question here from Matt. When do you get out? When do you know the market has peaked? So I'm assuming for the next cycle, how do you know when to get out of stocks when the market is about to peak and head lower in the next stock market crash? This is such an important question. Not so much for the direct answer, which I'll give you, but more so on a warning on it. And first, the direct answer, and this is something investors have tried to master for ages, and nobody ever gets close on a consistent basis. Even the so-called prophets that are able to forecast a market top in one cycle. You get the people that go on CNBC and say, oh, I called this one. I said a year ago or whatever. There's never been one that has been able to do it even within a year's range consistently. So over and over again at each cycle peak. Investors like Michael Burry, Jeremy Grantham, Nouriel Roubini like to say they predicted stock market crashes, but in reality, they're calling these things like every year. Every year comes out, they do more predictions of a stock market crash. So they're bound to be right eventually, right? A broken clock is right twice a day. The problem here is that if you listen to them, you'd be selling out of stocks way too early and miss out on a lot of the upside. So even after a crash, probably be no better off. Now that said, I do think there are some signs you can watch for that have pointed to a market peak before. And one is just this advanced decline line, which is comparing the number of stocks rising versus those falling on any given day. Now, if this line is rising or more stocks are rising rather than falling, it's just a good sign of overall investor sentiment. And when this starts breaking down, though, that's a sign that the narrative of a rising market has started to weaken. Now, another indicator is the monthly jobs report and the weekly unemployment filings. As long as people have jobs, they're going to keep spending. And with consumer spending as 70% of our economy, that's going to support sales growth and profits for companies. It's when these net new jobs in that monthly jobs report, when that net new job starts falling significantly and threatens to turn negative, or when there's a trend in unemployment filings heading higher, that's when you start to worry about the economy. And no amount of investor sentiment is going to save stocks from a weak economy. Now, another factor I watch for, and this is probably the most powerful indicator because you rarely hear about anyone else talking about it, but it's watching for weakness in those hot trending stocks that really drove the market up. Watching for weakness in those bleed into the rest of the market. And this always happens before a broader stock market crash. For example, in 2007, first we started seeing those mortgage lenders get crushed. Then we saw weakness in the broader housing market, then in the financials, and finally into the entire market. And if you look more recently, you started to see those hot growth stocks started falling in February of last year, a full 9 months before the rest of the market peaked. Now, if that selling would have stopped in the growth stocks, then we might have been fine, but you started to see that weakness bleed over into broader tech stocks, then into the rest of the market. So always be aware of that leadership in stocks. What stocks are leading the market higher, which are that hot theme, and if that breakdown in those leaders metastasizes into weakness more broadly, that's a sign that the market could be heading lower. Now for that warning though, even when you are worried about a market top, when you're worried about the next stock market crash, you never want to get completely out of stocks. One is because even the best analysts and forecasters can be off by a year or more on this, so you run the risk of missing out on a lot of the upside. More importantly though, is that investors have a tendency just to wait too long to get back into the market. They wait for a sign from above that stocks are rebounding, and they end up missing on most of the returns from that new bull market. I want to share a graphic here that I created and posted on the blog a few weeks ago. A great look into the psychology of market cycles, those emotions investors feel at different stages. And now if we start here on the right, around where it says despair along this line, That's the market bottom. That's when that perfect investor would be getting back into stocks. But now that's not what happens for the vast majority of investors that sell out of their stocks on the way down. You see here, as the market starts to recover on the right and then continued back on the other side of the chart, investors still doubt that rebound. They worry that it's just another bear market rally and that stocks will fall again, and they end up missing out on a lot of that new bull market. Now, I do think you can change your investing strategy at the margins when you think that the market has peaked. So maybe rebalancing a little bit to some of those safer assets, or just holding more cash, but you never want to get completely out of stocks altogether. Next question from Joe Badass. Love the name there. Are we in a recession? I think we have since the beginning of the year. Great channel, Joe from California. Thanks, Joe. I appreciate that. As for a recession, not yet. The economic data is still pretty good for the second and third quarter, but I think we will be in one next year. And most forecasts for economic growth have been downgraded to just 1 or 1.5% for the U.S. in 2023, and that just leaves no margin for error if we're seeing a recession. Again, it's just hard to imagine the Fed, which doesn't have a great track record for raising rates and not causing a recession. It's hard to see how they raise rates to 3 or 3.5% in 1 year this year and continue to do that in the next year without bringing growth to just a screeching halt. We've still got 5 more stock investing questions to highlight, but if you want to see which stocks I'm buying, the 7 biggest stocks in my portfolio, click through the link I'll leave in the description. This is a free report I put together with the Motley Fool. It's absolutely free, no obligation. Now, they are going to email you an offer for the Stock Advisor newsletter. I use it. I like the analysis, but there is no obligation to buy anything here. So look for the link below, get your free report, and you're going to be helped supporting the channel, so I appreciate it. Next question from Nick. How do you feel buying REITs still? He's got MPW, Realty Income, Stag, got all 3, adding PLD as well. And you know what? I love the REITs. Maybe I'm a little biased starting my career as a commercial property analyst, but I think these are great ways for investors to get that real estate exposure without owning property directly. REITs aren't going to be quite the diversifier as directly owning property. They still trade like stocks and tend to follow the stock market a little bit more, but it does help smooth out your portfolio just a little bit from these stock market crashes. Add in that inflation fighting power and a hedge against the dollar weakness, and you've got a must-own asset. Now, within REITs, I do like Stag, that's ticker STAG, and MPW, medical properties. O is popular, but not much for growth. I would say most of all, make sure you just have some healthcare REITs and data center REITs for that long-term picture. Next question is, Peter just needs me to predict the future, so no pressure there. Jackie says, criteria that makes a company great. How do you properly research a company? What KPIs are you looking for? What do they mean? What thresholds are you looking for? I think you have an in-depth view on how companies are looking and how to develop proper sound investors. Finance YouTube seen so many. Okay, so criteria to analyze a stock. Really, what do you look for? Now, this is another big question. So I'm going to link to 2 videos in the description. One, how to analyze a stock, and the other, the 10 financial ratios you can look for. So I'll focus on 5 points here I want to look at, but check out those 2 videos and the others on the channel for just really a full course in stock analysis. Now, first here, I'm going to be looking for companies with a competitive advantage in a growth industry. So I want to find an industry that has that strong growth potential where all the companies in that industry are getting that tailwind from just higher adoption and sales every single year. Then I want to find 1 or 2 companies in that have some kind of product or distribution, some kind of innovation that gives them an advantage over their peers. This might be in a brand name, loyalty to the product like Apple or Tesla. It might mean a tech innovation that changes how the product is delivered, like some of these companies are using with cloud software and software as a service, really just to serve their customers versus that traditional model or just any kind of tech innovation. You're really looking for that advantage that is difficult to duplicate by peers and is going to lead to that faster sales growth, maybe some premium pricing power, and increased market share. And honestly, folks, that takes a lot of research and really just knowledge about an industry. It's really why a lot of professional analysts only cover stocks in 1 or maybe a few industries, because they're reading the trade journals for the industry, they're reading through all the financial reports for every company in that industry just to understand the trends and the operations within it. It's also why you're going to take it, if you're going to take investing to this level of research, you might just consider just following a few industries like this, investing in those best of breed companies you find within those industries, and then just buying index or ETFs funds to cover the exposure in other parts of the market. You're going to be using this deep research, so you have that advantage picking stocks in 1 or a few industries put maybe 20% of your money in these best stocks where you have that advantage, and then get that market return on the other 80%. Now back to our criteria though, and I'm also going to be looking at the income statement for faster sales growth versus its peers, versus competitors, because this could be a signal of that advantage or some other factor for the company. And why is it that they are able to grow sales faster than all the others in that same industry? I'm also going to be looking for that higher operating margin and an improving operating margin versus its peers. So in the income statement here, that operating income divided by revenue currently and then over time, that's the company's core operating profitability. It's really how efficient management is at turning sales into profits. So obviously something you want to follow. Is management just more efficient than other companies, and is it getting more profitable? Now, finally, I'm using valuation as just that final decision on a stock. You look at a lot of the growth stocks over the past few years, and they check all those boxes for innovation, for sales growth, and profitability, but the valuation was just ridiculous on these things. There is no justification ever for buying a stock at 20 or 30 times on that price to sales basis. It just always ends up badly. That's not to say that you want to buy the cheapest stock in the industry either, because that competitive advantage, that faster sales growth, the higher profitability is going to justify a higher valuation. But you have to balance all these things out to find that right stock at the right price. Our next question is from Trashleet, a longtime citizen of the Bowtie Nation. So great to see your question there. I think something that consistently confounds people is the difference between a Roth and a traditional IRA and their impact on things like dividends. A great question here, again, from a longtime citizen of the nation. So good to see that. And these retirement accounts, that traditional IRA and the Roth, these are without a doubt the best investments you can make, so you really need to know about these. I've got a full video describing each and the differences that I'll link to in the description below, but they're both tax advantage accounts, so you're getting a tax break on your investments, which is what makes these so powerful. Now within the IRA, you put your money in before taxes, so whatever you contribute each year, you don't pay income taxes on that, though you are going to pay taxes on anything you take out in retirement, but that's 20, 30, 40 years from now. With the Roth IRA, this is a different type of IRA account. Here you're going to invest just like you would any regular taxable account after taxes, after you pay those taxes on your income. But any money you take out in retirement is totally tax-free. And now the 2 points I want to focus on right here, because doing all the differences or the benefits from these would be a whole video, but there are 2 points that deserve special attention. One is that since you're not paying taxes on those investments that you have in these accounts until you take that money out in retirement, it's a very important part of your investment strategy. For example, if you're buying dividend stocks in a regular account, a regular taxable investing account, you're paying taxes on any dividends you collect every single year, whether you take it out, whether you reinvest that money, whatever you do. If you receive a dividend, you're going to get a tax form in the next year and have to pay taxes on that money. And that's not so with these retirement accounts. Any dividends received in a Roth, in an IRA, in a 401k from your investments in these accounts, those are untaxed until retirement. So instead of losing some of that money every single year to taxes, you keep it in the account and just watch it keep on growing, that compound interest, right? This means you need to prioritize your highest income producing, highest dividend yielding investments for IRA accounts. You should be maxing out that annual contribution into your IRA or Roth IRA each year, around $6,000 max right now, and putting your dividend stocks in these. Now, the other point I want to make here is just not to overlook that Roth account. And people love that immediate tax break on the traditional IRA, so not paying taxes on the money you put in. But the money you take out of a Roth, again, is completely tax-free. That includes, what you put in, so you take that out because you already paid taxes on it, and the returns. I think that is so powerful, that tax break you get from it, so much more powerful than the tax break you get from a traditional IRA, to get that tax break on your returns, because over 20 or 30 years, those returns you make on stocks and dividends and everything else on that, it's going to be many more times than the money you put in. Okay, next question from Don DBN, position sizing. How much do you buy when the stock hits your target price? So buying a stock, what do you do if the price keeps falling? If you buy more, how much? Or do you wait to go back up? What do you do if the price rises immediately and you wanted to buy more? A lot of questions here, but a very important idea within your stock investing strategy. All you out there in the Bowtie Nation have heard me harp on just really having too much in any single stock, right? Just that risk that bad things even happen to good companies. So if you have more than maybe 10% of your money in a single stock, a single company, you're putting your entire portfolio at risk. So now when I'm buying a new stock, right, adding something to my portfolio, I'm not going all in on it because I do want to leave some room for adding to that position later without it getting to be too concentrated in my portfolio. And I think at most I'd usually be adding maybe 1 or 1.5% of my money into a stock at first, and more likely on the lower end of that, just to leave that room for adding to the position. Now, if the stock does fall significantly, you have to assess why that happened, why it's falling. If it's just a matter of the entire stock market is falling, then that's something entirely different, right? It's just the market selling out of everything. Now, if it is specific to that company, then this, and if this is something that changes your initial analysis. So in those factors that we looked at before, like competitive advantage, sales growth, operating margin, and innovation, did those change materially? Did whatever is bringing the stock down, the stock price, did that change in those factors that you look at? And I'm not talking about sales growth falling just a little bit here, but really a shift in the company's position against its peers. If sales growth is falling across the entire industry and your company still has that higher sales growth that you watch for, then this still has the advantage. It's still a good stock to own. Now, if, however, something has changed at the company, at the specific company, where it doesn't have that advantage anymore within the industry, then you have to reevaluate that dispassionately. Look at that stock. Don't get emotional about it just because you own it, and understand whether you want to hold it, buy it, or maybe even sell it altogether. Now, where this comes back to the question is, if that stock price is falling, but it's still a strong company, then you want to take advantage of that with a lower price to buy more shares. Again, though, you want to do this strategically. So maybe put in another 1% of your wealth after that stock has fallen, maybe 20%. So not after it's fallen 2 or 3% and keep on following it all the way down, but after a major fall of like 20%. And then add maybe another 1% after successive 20% drops. Again, you don't want to be buying in more every 2 or 3% drop in the shares, because you could very quickly have a stock that's like 30% of your portfolio and just continues to drop. Again, on all this though, I would limit the buying to no more than 5 or 7% of my portfolio in any single stock. So if you're buying as that stock falls and you've already hit 10% in it and it keeps falling, you cannot buy anymore, because you can follow a stock all the way down and just wipe out your entire portfolio if you let it. Next question from Kat. My question is, when do you give up on a stock and start selling even at a loss, after 40 or 50 or 60% down? She says Amazon went over $100 a share to $5 a share in the train wreck of 2000. And I love the analogy because we know what has happened to Amazon after that. Amazon bottomed at like $5.60 a share in 2002 and has gone on to 50,000% return. So you never want to sell just because the stock price has fallen. But anyway, and now look at it. Personally, she owns shares of Plug Power. Did sell some back for a gain in 99. Can remember it was $1,000 share back then, but it's dwindled down to a few dollars. Sold all of it at a loss slowly, 20 years to offset other gains. And now, to her surprise, it's done reasonably well over the last few years. And I think it's a great question and a great comparison, really, right? Because, we saw two stocks, both Plug Power and Amazon, just really crash hard into the single digits and then rebound just as much. And you can kick yourself a lot of times if you sell out. But then again, sometimes they don't rebound and you made a good decision. And I think it's what a lot of investors are struggling with this, investing in those high-flying growth stocks over the last couple of years where the valuations were just ridiculous. And now their faith is really tested in the future of these stocks and have racked up some massive losses. Again, I love that analogy of Amazon, though, because you need to keep that long-term picture. And the story in the market for a lot of these growth stocks, Teladoc Health, SoFi Technologies might have changed, but if you look at these companies, they're still booking 20% sales growth every single year. And they still have that competitive advantage in a growth industry. And they are still that same growth company they were a year ago. Maybe a little off track. We will get back to the question. But the point is, you don't want to sell a company just because the stock price has gone down, right? Go back, you evaluate the company's future and its growth. If it's still the same growth company that you bought and still has that same future, then the returns from now forward should be a great investment. Of course, that doesn't mean you pay any price for growth. And that's where a lot of investors went wrong over the last couple of years, paying those 20 and 30 times or more on a price to sales basis for stocks. So again, I wouldn't necessarily sell just because of the losses or the stock price has gone down, unless the company or that entire industry has fundamentally changed and the growth is just no longer going to be there. I would sell if maybe management has changed the business model or if the company has lost that competitive advantage over its peers. Don't forget to watch for our next 10 stock investing questions or click on the video to the right for a step-by-step in creating a dividend stocks ladder, how to use dividends to pay your bills. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.